Well, maybe the market didn't get exactly what it wanted from the Fed today, but yields and banks both shot higher after the decision to cut rates by 25 basis points. And that's exactly what our next guest said would happen when the biggest bubble ever finally burst in the bond market. So now what? BTIG Managing Director and Chief Equity and Derivative Strategist Julian Emanuel joins us here. Julian, it's always great to have you.
Great to be here.
So is this it? Bonds, it's over? The trade's over?
Did we burst?
We burst. We burst. If you look back at August, going from 205 in the 10-year yield down to 145, and then you come in the day after Labor Day and get the very appropriate supply response with literally record corporate issuance, government issuing debt to finance the ballooning deficit. And, you know, essentially the realization, if you look at these economic surprise indices, they are skyrocketing in the U.S. The data is better than everyone thinks it is. So from that perspective, yes, we think the bubble has burst. And we think that if you look at today, that's probably one of the single biggest factors that essentially a day which, you know, we didn't think the Fed did quite as well as others might have today, that stocks held their own and bonds held their own. People own too many bonds.
Why do you think that the Fed didn't do as well as other people have said? Because, I mean, last Fed meeting was a disaster. I mean, oftentimes when he opens his mouth and he goes off script, it's just a recipe for a sell-off. And we've seen that many times.
Well, he held the script, so that was good.
He actually was reading off
the paper. He was reading off the paper,
a lot of it.
And that was good. But the point is, you know, the dots have taken out any even sort of like risk management sort of one-cut expectation. You know, the market still believes there are going to be cuts. You know, and you raised your economic forecast for 2019 and 2020 when everyone else is taking their numbers down, which is surprising. And then on this whole issue of the repo and the funding and the liquidity deal the last few days, it seemed a little too sort of trite to us to say, yeah, we recognize it's an issue, but we'll be able to take care of it. And oh, by the way, it doesn't really matter to monetary policy and to the economy. And we would say, you know, tell that to friends of mine who know nothing about the financial markets and have gotten, you know, in their inboxes this thing about the repo the last couple days, and they're calling me and asking me, what the heck is this? It matters with regard to confidence, and confidence is the thing that turns markets down when it turns down.
So part of this money market problem that we had was because there was too much supply of debt out there, right? And so if the bond bubble has burst and the corporations are still issuing and the U.S. government is still issuing, when does that become a problem for stocks? Right now it seems like it's okay, but I imagine at some point you can't absorb all this debt and it becomes a problem for stocks.
Well, again, if you go back to the last couple of years, it doesn't necessarily become a problem for stocks until you get substantially higher in terms of yields. The stresses that we've seen were sort of really much closer to 3% than, you know, 1 3/4% on the 10-year yield where we are now. I think, again, it's much more a function of, you know, the market is expecting a deal of some sort. The market is expecting some sort of, you know, reasonably neat resolution to Brexit. Iran, you know, we've already sort of shrugged it off the last couple of days. You look at the energy market. Sometimes all those things aren't necessarily going to turn out perfectly, though we would say that looking into an election year, you know, politicians incumbent, whether in the White House or anywhere else, are going to ensure that there isn't a recession.
So a bursting of the bond bubble is not a problem for stocks. It's not a problem in terms of yields going higher until we're more like 3%, which we're far off from right now.
Right.
So what does this all mean for your view on equities?
So our view is if you look at 2019, it's been very interesting in that the underperformance of small caps relative to large caps have literally followed 10-year yields tick for tick. Essentially, small caps being, you know, sort of less liquid on balance and the place where people fear recession. Small caps are going to lead the equity market higher in the fourth quarter. They also tend to seasonally as well. Look, our price target is where it is, basically 3,000. So from our point of view, the trading range hasn't broken either way. We don't necessarily think it's going to in the immediate term. But small caps have been under-owned, under-loved, just like financials, just like energy, and they will eventually lead the broader indices higher.
So, Julian, you touched on it in the beginning. When you look at the balance sheet, and it snuck up on everybody when we had quantitative tightening, and they didn't realize it was basically raising at every meeting. Now, when you have another QE round or using that balance sheet, is that just throwing in the white flag that it's all over and we are 17% of GDP on that balance sheet?
Well, look, the rules have been rewritten over the last several years. And, like it or not, central banks are, perhaps an uncomfortable, player in the financial markets. But, we haven't had an accident yet. And the assumption is that we will continue to potentially not have an accident. That's certainly what the market's saying. And the way we look at it, if anything, the last several weeks have been good because the ECB and now the Fed are telling you that there need to be other ways of keeping the economy moving forward, whether it's fiscal stimulus from Germany or resolving the trade war. The message today was fix the trade war, in our view.
All right, Julian, thank you so much. Julian Emanuel of BTIG. Quickly on small caps.
IWM, we talked about the line in the sand being 145. It held spot on, and it's rallied now. I think it's 156. Closed lower today, not a big deal. I think, again, small caps have led. The fact that they haven't made a new high, despite the fact the S&P is effectively there, is concerning. But again, I've tried to bring up the bear case on dozens of different ways, and none of them seem to hold water.
So if you look at what rallied above where it was before Fed, I think the most impressive are semis, and also look at banks. I mean, banks responded, and so we talked a bit about that. The cyclicality in here, I think, is very important. Semis, which people have been trying to push down and say that they can't make new highs, I think that is probably the most extraordinary move today.
I love the call on the small caps, particularly for two reasons. One, because they tend to have a lot of regional banks, which do much better when you get a steeper yield curve, which looks like maybe we're going to try to get something like that. And secondarily, they're undercovered and underloved because of a lot of things that have been going on with research on Wall Street. So you get this kind of whipsaw effect in it. So I like that a lot.